I just want you to imagine for a second an $11 billion pile of cash.
That is a lot of cash.
Right, just sitting there. It's stacked up, completely unclaimed, year after year, just, waiting to be picked up by the local small businesses in your neighborhood.
It is, it's a staggering mental image. And the wild part is that we aren't talking about some theoretical economic projection here.
Yeah.
That is actual real world capital that is currently being left on the table.
Exactly. And whether you own a small business yourself or you just want to understand the invisible economics of your favorite local spots, that coffee shop you visit every morning or the salon down the street, our mission in today's deep dive is to figure out exactly why that money is just sitting there.
Right. The invisible plumbing, so to speak.
Yeah. We are unpacking IRS Code Section 45B, that's the FICA tips tax credit, and we're exploring how some massive recent legislation has completely rewritten the playbook for the service industry.
It really has.
So, okay, let's unpack this, because the statistics we found in the sources are, they're mind-blowing. It's estimated that 80 to 90% of small businesses in tipped industries completely miss this credit.
80 to 90%.
Yeah, they just walk right past it. And the median refund they're leaving behind is $101,000.
Which is, for a small, locally owned restaurant or a neighborhood barbershop, that is transformative capital.
Oh, absolutely.
That kind of money is often the difference between, opening a second location or having to close your doors permanently.
Right.
And we have to establish right up front that leaving this behind isn't just a simple accounting error where someone forgot to carry a 1 on their tax return. It represents a profound systemic gap in awareness.
A huge blind spot.
Exactly. To put it simply, the core concept we are looking at is a dollar-for-dollar general business tax credit.
Okay, wait, let's slow down on that for a second. When you say a dollar-to-dollar credit, you mean it's not just a deduction that lowers your taxable income, right?
Right.
It's like a direct subtraction from the final tax bill you owe the government.
That is the critical distinction, yeah.
Mm-hmm.
If you owe the IRS, say, $50,000 in income tax and you have a $50,000 credit, your tax bill drops to zero.
Wow.
And this specific credit applies to the 7.65% employer portion of Medicare and Social Security taxes. We generally refer to those as FICA taxes.
Right, the payroll tax.
Exactly.
Yeah.
Whenever an employee gets a tip, the business owner is legally required to pay that 7.65% FICA tax on that tipped amount out of their own pocket.
Out of their own pocket, okay.
Yeah. And Section 45B allows the employer to claim that exact amount back as an income tax credit.
So to really understand why $11 billion is just, sitting around ignored, we have to look at the mechanics of how this secret credit actually works.
Right.
When I was reading through the sources, the best way I could visualize it was like a retroactive manufacturer's rebate, but for your taxes.
Oh, I like that.
The business has already paid that payroll tax throughout the year as their employees earn and report tips. The money has already left their bank account.
Yeah.
But then at the end of the year, the government is essentially handing them a rebate coupon to offset their overarching business income tax.
That is a highly functional way to look at it, actually. The business fronts the money to the payroll system, and the IRS rebates it against their income tax.
Okay, but here is where I have to push back a bit, because reading this immediately raised a red flag for me.
Oh, what's the flag?
Well, if the employer gets a credit on those FICA taxes, and, FICA is the literal funding mechanism for Social Security and Medicare, does that drain the employee's future benefits? Are we effectively robbing the worker's retirement to pay the business owner today?
Yeah, it is a very logical assumption to make when you look at the mechanics, but
Yeah.
the answer is definitively no. Yeah, the employee's benefits are entirely insulated. Their future Social Security and Medicare benefits are calculated based on their total reported wages and tips, completely, regardless of whether the employer claims this credit or not.
Okay, that is a huge relief.
It is. This provision strictly and solely offsets the employer's tax liability. It has zero negative impact on the worker. And what's fascinating here is the historical context behind why the government designed such a seemingly generous loophole.
Yeah, because I always assume the IRS doesn't do anything just to be nice, right? There has to be a structural reason.
Well, there is. We have to look back to 1993. At that time, the IRS was facing a massive data problem. The service industry was operating almost entirely in a cash ecosystem.
Oh, right, the pre-digital era.
Exactly. And the government realized that only about 15% of tips were actually being reported for taxes.
Only 15. That's nothing.
It's nothing. But imagine the sheer logistical impossibility of auditing millions of individual diners, trying to track, crumpled up $5 bills left on diner tables across the entire country.
Yeah, they couldn't just send an auditor to sit in every diner in America.
The IRS just couldn't enforce compliance through sheer force. So they essentially created a compliance buyout.
The compliance buyout.
Yeah, they enacted Section 45B to incentivize employers to do the policing for them. The deal was, if you, the business owner, actively encourage your employees to accurately report all their tips, we know your payroll taxes are going to skyrocket.
Because they have to match the FICA on that new higher reported income.
Exactly. So to prevent you from actively hiding the cash alongside your employees, the government promised to refund that matching payroll tax as an income tax credit.
Wow. It's pure behavioral economics.
It really is.
They needed the data, so they made it incredibly lucrative for the business owner to enforce the compliance themselves. And they built in some serious flexibility, too, which I noticed in the sources.
Yes, the carry provisions.
Yeah. If you can't use the whole credit in your current tax year, say your business didn't have a lot of income tax liability because you had a slow year, you don't just lose it. You can carry it back 1 year to get a refund on past taxes, or carry it forward for up to 20 years.
It operates as a highly durable asset. A restaurant could stockpile these credits during lean years and deploy them decades later when they are highly profitable.
That's amazing.
But, as you might have noticed, the 1993 law was designed primarily, almost exclusively, for the food and beverage industry.
Right. Which begs the obvious question. If this rule has been sitting on the books since the 90s, why are we doing a deep dive on it now, looking ahead to 2026?
Because the rules of the game just fundamentally changed.
Oh, yeah.
The sources detail a massive piece of legislation referred to as the One Big Beautiful Bill, or the OBBB.
The OBBB.
Signed into law on July 4, 2025. And looking at this impartially, completely setting aside the politics of how the bill was passed, the structural impact on our local economies is profound.
Completely profound.
The OBBB officially aligned the beauty and personal care industry with the restaurant sector.
That is a massive expansion. I mean, I think about the salons in my town. You have hairstylists, colorists, barbers, massage therapists. Tipping is such an ingrained part of that ecosystem.
Oh, absolutely. And if effective December 31st, 2024, meaning businesses can claim this on their 2025 tax returns moving forward,
Yeah.
those hair salons, barbershops, nail salons, and body spas can now claim that exact same dollar-for-dollar tax credit on employer-paid FICA taxes on tips.
But the sources show the OBBB didn't just hand the beauty industry a blank check, did they?
No, they didn't.
There is a very specific new hurdle they have to clear that restaurants don't.
Right. The most critical new mechanic for the beauty and personal care sector is a strict threshold requirement. For a salon or a spa to even qualify for a single dollar of this credit, their total tip income must exceed 15% of their gross receipts on an annual basis.
Wait, tracking that sounds like an absolute logistical nightmare for a small business owner.
It is very rigorous, yes.
So if a salon does $1 million in revenue, they have to prove they took in at least $150,000 in tips. If they hit, say, 14%, they are completely locked out of the credit.
They get nothing.
Wow.
Which means tracking every single dollar becomes a matter of financial survival. And it gets incredibly complicated when you look at mixed-use spaces. Consider the med spa caveat we found in the sources.
This was fascinating because med spas are a booming industry right now.
Yes, they are everywhere.
You have facilities offering everything from basic facials to medical-grade injections under one roof. But how does that 15% threshold work when the tax code views those services entirely differently?
The IRS is remarkably rigid about the definition of customary tipping. Customary tipping does not apply to medical professionals.
Okay.
If a doctor or a registered nurse administers Botox or dermal fillers, tipping is neither expected nor professionally permitted. Therefore, those specific services do not generate qualifying tips.
But in that exact same building, maybe just one room over, if an esthetician gives you a non-medical facial or like a salt scrub, that does warrant a tip.
Exactly. And those tips do qualify for the credit. The tax code essentially draws an invisible line right down the middle of a single spa.
That's crazy.
If the owner isn't meticulously separating the gross receipts of the medical side from the non-medical side, One miscategorization of a Botox tip could artificially inflate or deflate their numbers.
Which could potentially ruin their ability to hit that 15% threshold.
Exactly.
That level of detail is intense. And it brings up another question about the structure of a salon. What about my stylist who just rents a chair?
Oh, the booth renters.
Yeah. In a lot of barbershops and hair salons, the workers aren't technically employees. They're independent booth renters.
Right.
Do they generate this credit for the shop owner?
They do not. And the reasoning goes back to the core mechanics of the tax code. A booth renter is an independent contractor. They operate their own micro-business within the salon.
Right.
Because they aren't W-2 employees, the salon owner isn't paying the employer portion of their FICA taxes. The contractor pays their own self-employment tax.
Ah, I see. So the salon owner can't get a rebate on a tax they never paid in the first place.
Exactly the case. The independent contractor already has mechanisms to deduct portions of their self-employment taxes on their personal returns. Section 45B is exclusively designed as a shield for businesses employing W-2 staff.
Okay, so a qualifying beauty business needs to have W-2 employees, hit the 15% gross receipts threshold, and carefully separate out any medical services.
Yep.
But even after all that, there's this bizarre legislative quirk regarding the minimum wage baseline. I call it the time capsule quirk.
Well, it is one of those strange artifacts that happens when laws are patched together across different decades.
Yeah.
As we discussed, the tax credit applies to tips, but it only applies to tips that exceed the federal minimum wage.
Right.
For the restaurant industry, however, they don't use today's minimum wage to calculate that baseline. They use the federal minimum wage as it existed on January 1st, 2007.
Which was $5.15 an hour.
A 2007 act literally froze that specific number in amber for the food service industry. A restaurant gets the tax credit on any tips an employee makes after that $5.15 threshold is met by their combined wage and tips.
But the OBBB was passed in 2025.
And when the OBBB added the beauty and personal care industries, lawmakers did not grandfather them into that 2007 rate. For salons and spas, the baseline is set at the current federal minimum wage of $7.25.
So the beauty industry has a slightly higher financial hurdle to clear before the tax credit kicks in, purely because of the calendar year their respective laws were passed.
Exactly.
It's a literal time capsule embedded in the tax code. But once they clear that hurdle, a savvy business owner listening to this might be thinking, great, I'm just going to mandate an 18% service charge on every single bill, rack up a mountain of tax credits, and buy a yacht.
The IRS anticipates that exact strategy, which is why they are incredibly aggressive about defining what legally constitutes a tip. They do not view a mandatory service charge and a tip as interchangeable.
Here's where it gets really interesting. Because reading through the rules, the analogy I came up with is the difference between a cover charge at a club and passing the hat at an open mic night.
Oh, I like where this is going.
Right. Like if a club says you must pay $20 to enter, that's a mandatory cover charge. You have no choice. It's just revenue for the club.
Sure.
But if you're at an open mic and someone passes a hat around, you can throw in a 5, you can throw in a 20, or you can just pass it along empty. That's a tip.
The IRS philosophy completely aligns with that. They view a true tip as a spontaneous gift, not as guaranteed revenue.
A spontaneous gift.
Exactly. And they take your open mic analogy a step further. It's not just about passing the hat. It's about who gets to keep the money inside it. The IRS dictates that the customer must have the unrestricted right to determine the amount.
Okay.
The payment cannot be dictated by employer policy. And crucially, the customer must have the right to determine who receives the payment. Compulsion kills the tip.
So let's apply that to a real-world scenario from the sources, because this is something we see literally every time we go out to eat, and I never realized the massive tax implications happening behind the scenes.
Let's do it.
Let's say I go to a restaurant with a party of 6. The menu states that an 18% charge is automatically added to parties of 6 or more. The bill comes, the 18% is already baked into the total. Since I was forced to pay it, that means it's a revenue, not a tip.
The IRS classifies that as a service charge. Because the employer dictated it and you had no unrestricted right to alter it, it is treated as regular wages when distributed to the employee.
Wow.
It absolutely does not qualify for the FICA tip credit.
Wait, so when a restaurant brings me a receipt that leaves the tip line completely blank, but at the bottom they helpfully print out the math for me, saying 15% is this much, 18% is this much, that isn't just them being helpful. That's a deliberate tax strategy.
It is a vital distinction in formatting. By leaving the line blank, The employer preserves the spontaneous gift status of the transaction.
Unbelievable.
You, the customer, are reading their suggested math, but you are freely choosing to write down that amount. You entered it, free from compulsion.
Yeah.
Therefore, it is a qualifying tip under Section 3121 of the Code, and the employer can claim the tax credit on it.
It's amazing how the mere formatting of a piece of receipt paper can be the difference between thousands of dollars in tax credits or absolutely nothing.
It really is.
But if the IRS is this strict about tracking every penny, what happens if an employee just hides their cash? Because going back to 1993, the whole point was to uncover hidden cash.
Right.
If a bartender pockets a $100 bill and never tells the owner, is the owner suddenly liable for the payroll taxes on money they never knew existed?
That would be an untenable risk for a business. The tax code provides a specific safe harbor under Section 3121 MOQ.
Okay.
If an employee hides cash tips, the employer is protected. They're not liable for the FICA taxes on those unreported tips until the IRS officially issues a notice in demand for the taxes.
That makes perfect sense. It keeps the liability on the person actually hiding the money until the government audits the situation and steps in.
Exactly.
Okay, so we've explored the federal rules, the time capsules, the receipt formatting. But federal rules are only half the story because we live in the United States, and how this plays out across the actual map of the country is completely wild.
It gets very complicated geographically.
Yeah, state labor laws heavily contradict federal laws, creating a massive paradox.
If we connect this to the bigger picture, we have to look at how different states handle the tip credit minimum wage. This is where federal tax law and state labor law collide, and the results are incredibly counterintuitive.
Explain the math on this to me, because looking at the sources, it seems like the states that are historically the most strict, the most heavily regulated regarding businesses, actually end up handing those same businesses the absolute biggest federal tax windfall.
To understand why, we have to slow down and look at how a tipped wage is calculated federally versus locally. Under federal law, the minimum wage is $7.25.
Yeah.
But the federal government allows an employer to pay a tipped worker a direct cash wage of just $2.13 an hour.
Right.
The employer then uses the employee's tips to bridge the gap, covering the remaining $5.12 to hit that $7.25 minimum.
Okay, so the federal government lets the business use the customer's tips to satisfy the baseline minimum wage requirement.
Yes, but remember the rule for the FICA tax credit. You could only claim the credit on tips that exceed the federal minimum wage threshold.
Right.
We established earlier that for restaurants, that threshold is frozen at $5.15. So in a state following the federal rule, the first $5.15 of tips per hour is burned up just getting the employee to the baseline.
Oh, I see.
That initial chunk of tip money does not qualify for the tax credit.
Got it. But then you have states with totally different labor laws. California, Washington, Nevada.
7 states entirely ban the tip credit minimum wage: California, Washington, Nevada, Oregon, Montana, Minnesota, and Alaska. In those states, an employer cannot use a single dime of tips to meet the minimum wage. They are legally required to pay the full state minimum wage out of their own pocket.
Wow.
And those minimums are substantial. For example, the sources note that in 2026, California's state minimum is $16.90 and Washington's is $17.13.
Let me make sure I have this straight. A business owner in Seattle or Los Angeles has to pay almost $17 an hour in base pay before a single tip is even factored in.
Yes.
That is a massive upfront labor cost. But the federal threshold for the tax credit is only $5.15.
Precisely the point. Because the state forces the employer to pay $16.90 in base wage, the employee is already light years past the $5.15 federal requirement before a customer even walks in the door.
So the very first dollar of tip money is instantly eligible for the tax credit.
100% of the tip pool becomes eligible.
That's insane.
None of the tips are being used to satisfy the minimum wage, so every single penny qualifies for the 7.65% federal tax credit. The strict state labor laws, by forcing employers to absorb the full, heavy cost of the minimum wage up front, accidentally supercharge the federal tax relief for those specific businesses.
That is just incredible. The irony of it is brilliant. The states imposing the heaviest labor burdens are unintentionally creating the most pristine conditions for a federal tax shield.
It is quite the paradox.
So what does this all mean? We started today by talking about an $11 billion pile of unclaimed cash and a median refund of $101,000 for small businesses.
Right.
We've explored how the 1993 laws tried to pull the restaurant industry out of the cash shadows, and how the recent OBBB expanded that same logic from the dining room to the salon floor. And what really strikes me is that this is one of the rare times you see a piece of legislation create a true win-win.
It really is.
Because the sources point out that the OBBB also allows employees to deduct qualified tips on their personal income taxes, right?
It does. It provides a massive incentive for the worker to report every dollar they earn.
But the sources explicitly clarify that if the employee takes that personal deduction, it does not stop the business from getting their massive FICA credit.
Exactly.
They are mutually exclusive benefits. The employee lowers their tax burden, and the employer lowers theirs.
Which brings us back to the core value of doing a deep dive into material like this. Knowledge is only power when it is understood and applied.
Absolutely.
If you own a qualifying business, or if you know the owner of your favorite local restaurant or salon, the mechanism to claim this is IRS Form 8846.
Form 8846.
And the most crucial point is the timeline. They can retroactively claim this for the last 3 years. That is why the median refund sits at over $100,000. It is literally waiting to be claimed, but the clock does run out.
The clock runs out, and if you don't file the paperwork, that money just evaporates back into the ether. It's a fascinating look at the invisible plumbing of our local economies.
It certainly is.
But, looking at all of this together, the IRS hunting for data in 1993, the new OBBB regulations, the strict mathematical tracking of blank receipt lines, it leaves me with a lingering thought that wasn't explicitly spelled out in the sources, but feels like the inevitable conclusion of all this tax code engineering.
How about that?
Well, with the new laws heavily incentivizing employees to report everything through personal income deductions and simultaneously incentivizing employers to ensure that reporting through these massive FICA credits, the government has perfectly aligned both sides to track gratuities digitally.
Yes, they have.
Are we witnessing the final death of the cash is king, off the books era in the service industry? And if the tax code eventually turns every single tip into a perfectly tracked, digitized data point, how does that fundamentally change the historic, unwritten relationship between a customer, a server, and the nature of a tip itself?
That is a very interesting question.
Something to ponder the next time you leave a blank line on a receipt.